Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Insight Enterprises Inc. Annual Report. Insight Enterprises Inc. offers a wide range of businesses and services that cater to various industries. At the core of its offerings are multi-cloud solutions, which manage and support cloud and data center platforms, modern networks, and edge technologies. The company also provides cybersecurity solutions that automate and securely connect modern platforms. In addition to these key areas, Insight Enterprises offers a variety of other services, including data and artificial intelligence solutions, digital workplace and device solutions, and intelligent application solutions. Its software maintenance solutions provide clients with access to software upgrades, bug fixes, help desk support, and other services. The company also offers vendor direct support services contracts and cloud/software as a service subscription products. Insight Enterprises serves a diverse range of industries, including construction, esports, financial services, healthcare and life sciences, manufacturing, retail and restaurant, service providers, small to medium businesses, and travel and tourism. With its extensive portfolio of services and expertise in various sectors, the company is well-positioned to meet the complex needs of its clients. The company's solutions combine hardware, software, and services to help businesses achieve their goals. Its experienced team designs, procures, deploys, implements, and manages these integrated solutions, ensuring that clients receive comprehensive support throughout the process. With a strong presence in the market since 1988, Insight Enterprises has established itself as a trusted partner for businesses seeking innovative technology solutions. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what might cause a stock price to drop significantly. The stock price of Insight Enterprises Inc. has dropped significantly over the past year due to various market and economic factors. One possible reason is the company's failure to meet investor expectations in terms of revenue growth and profitability. This could be attributed to changes in consumer behavior, increased competition from other technology companies, or a decline in demand for their products and services. Another factor that might have contributed to the drop in stock price is the company's exposure to economic downturns. As a technology company, Insight Enterprises Inc. may be vulnerable to fluctuations in global trade and economic conditions, which can negatively impact their sales and revenue. Additionally, poor management decisions or lack of innovation within the company could also lead to a decline in stock price. If the company fails to adapt to changing market trends and customer needs, it may struggle to remain competitive, leading to a decrease in investor confidence and a subsequent drop in stock value. Lastly, external factors such as changes in government regulations, industry disruptions, or unforeseen events like natural disasters can also impact a company's stock price. These events can create uncertainty and volatility in the market, causing investors to lose faith in the company's ability to perform well in the long term. Insight Enterprises, Inc. maintains a market capitalization of $3 billion, broadly in line with the industry peer group. Insight Enterprises, Inc. trades at a higher price-to-earnings ratio of 18 times and a higher price-to-book ratio of 1.61 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 76% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through a review of the company's financial performance. Net sales decreased by 5.2% from 2023 to 2024, but showed significant increases in certain regions such as North America, 4.6%, EMEA, 70.8%, and APAC, 116.7%, from 2024 to 2025. Segment-wise revenue analysis reveals that hardware revenue declined across all regions, while software revenue increased in North America and APAC. Services revenue also showed declines in most segments. However, the company's geographic revenue data indicates a strong performance in the United States, with net sales reaching $6,213,872,000 in 2025. The impact of depreciation and amortization on revenue growth is evident, particularly in the North America segment, where it increased from $22.9 million to $24.8 million between 2023 and 2025. The company's acquisitions also played a significant role in driving revenue growth, with notable purchases such as Securo, $79.5 million, and Inspirelevin, $209.7 million. Overall, these factors contribute to the complex dynamics of revenue growth or decline for the company. The net income of the company experienced a significant decline over the past 2 years. In 2024, it decreased by 11% from $281.3 million to $249.7 million compared to 2023. This downward trend continued in 2025, with a further decrease of 37% to $157.3 million. The reasons behind this decline are multifaceted and include aggressive pricing competition, loss of partner funding incentives, decreased demand for current products and services, inventory obsolescence, and failure to adapt to new distribution channels or competitors. The profit margins also underwent changes during the same period. The gross profit margin initially decreased from 46% in 2023 to 43% in 2024, but then increased slightly to 41% in 2025. However, this increase was not enough to offset the decline from 2023 levels. On the other hand, the operating profit margin continued to decrease, dropping from 4.6% in 2023 to 4.1% in 2025. The factors contributing to these changes in profit margins are varied and include price reductions by competitors, inventory impairment charges, reduced operating margins, higher taxation and tariffs, increased costs from hedging activities, seasonal reductions in business activity, regulatory and legal risks, public sector contract uncertainties, changes in tax rules and regulations, and increased interest expenses and debt service payments. These challenges have had a cumulative effect on the company's net income and profit margins, leading to a decline over the past 2 years. The company's financial performance indicates a consistent generation of positive operating cash flow over the past 2 years. In 2024, the company generated an impressive $632.8 million in net cash provided by operating activities. Although this figure decreased to $303.8 million in 2025, it remains positive, demonstrating the company's ability to maintain a healthy cash inflow from its core operations. This trend suggests that the company is effectively managing its resources and generating sufficient cash to support its growth and investments. The company's financial situation has undergone a significant transformation in recent years. One of the most notable changes is the substantial increase in its long-term debt. As of December 31, 2025, the total long-term debt outstanding stood at $1,361.3 million, marking a staggering 156% rise from $531,233 in 2024. This significant jump in debt has naturally led to an increase in interest expenses. The company's net interest expense rose by 46%, or $26.8 million, between 2024 and 2025. Furthermore, the interest expenses associated with the ABL facility also saw a notable increase from $32.6 million in 2024 to $48.3 million in 2025. The data suggests that the company's debt level and interest expenses have undergone a significant change, indicating a shift in its financial strategy or circumstances. The substantial rise in long-term debt and corresponding increase in interest expenses are clear indicators of this transformation. The performance of various segments and regions in the given period has been notable. In terms of segments, hybrid multi-cloud, cybersecurity, and data and AI have performed well. These areas have shown significant growth and development. Looking at the regional performance, North America has seen a substantial increase in assets, rising from $6,704,511,000 in 2024 to $7,018,025,000 in 2025. EMEA has also experienced a notable surge, with assets increasing from $1,484,341,000 in 2024 to $2,528,292,000 in 2025. The APAC region has shown growth as well, with assets rising from $190,678,000 in 2024 to $412,016,000 in 2025. In terms of specific countries, the United States and the United Kingdom have notable sales and assets, with net sales of $6,213,872,000 and total long-lived assets of $157,719,000 for the U.S., and net sales of $683,028,000 and total long-lived assets of $16,556,000 for the U.K. Management is optimistic about the company's future prospects, citing a strong foundation for growth. To drive profitable expansion, they are focusing on doing a few key things well, including recurring services revenue and gross margin expansion. The company is also investing in digital platforms and cloud-native systems to improve customer experience and efficiency. A key strategy is to expand solutions expertise into new areas, such as hybrid multi-cloud, cybersecurity, data and AI, digital workplace and devices, and intelligent applications. This will involve partnerships with leading manufacturers and publishers, which may make the company more reliant on certain partner relationships. Management is also emphasizing the importance of attracting, developing, and retaining top talent globally through leadership training and inclusion initiatives. They expect gross margins to continue expanding as they focus on selling solutions and increasing services net sales. However, management is also aware of various risks and challenges facing the company, including aggressive pricing competition in the industry and potential impacts from partner funding programs. They are anticipating higher than historical interest rates in 2026 and focusing on transformation costs that are unique in nature and not expected to recur in the longer term. Overall, management's strategy is centered around driving profitable growth through strategic investments, partnerships, and innovation. The company's financial strategy has been focused on investing in its growth rather than distributing profits to shareholders. Despite having the opportunity to pay dividends, the company has chosen not to do so, instead opting to reinvest its earnings into the business. This decision is likely driven by a desire to maintain control and flexibility in its operations. In terms of share buybacks, the company has taken two approaches. Firstly, it has made strategic acquisitions, such as Inspire11 and Securo, which have allowed it to expand its capabilities and presence in the market. Secondly, it has conducted a direct share buyback program, purchasing approximately $148 million worth of shares from existing shareholders. This move is likely intended to reduce the company's outstanding share count and increase earnings per share for remaining investors. Concerns about inventory buildup and supply chain disruption. The company faces significant concerns regarding inventory buildup and supply chain disruption. A loss of a major partner relationship could lead to product unavailability, page 12. Furthermore, the rapid pace of technological change in the IT industry poses a risk of inventory obsolescence, resulting in potential write-downs of obsolete stock, page 14. Financial data also indicates potential concerns about existing debt levels related to inventory financing. The company's net borrowings under inventory financing facilities increased from -$13.6 million in 2024 to $6.4 million in 2025, page 38. Additionally, a buildup in inventories is explicitly mentioned as a concern on page 48. Recent data also suggests potential issues with inventory management. A decrease in inventories, -37,396, and an increase in accounts payable, 1,047,396, indicate that the company may be struggling to manage its supply chain effectively, page 58. These concerns highlight the need for the company to address these issues promptly to avoid further disruptions. That concludes the financial summary for Insight Enterprises, Inc. Feel free to comment below, and I will be happy to answer them when possible.